In August 2017, MoviePass dropped its price from $50 to $9.95 a month for unlimited movies. Wall Street analysts immediately called it financial suicide. The CEO called them pessimists. Within 2 years, MoviePass burned through over $150 million, crashed to zero, and filed for bankruptcy. But here's what's haunting. The executives saw the data showing they were failing every single month and still believed they'd succeed. This isn't a story about a bad business model. It's a story about the psychological bias that makes smart people make catastrophically dumb decisions with other people's money. Let me ask you something. When you started your last project, did you think it would take longer or shorter than you estimated? If you're like most people, it took longer, way longer. That's not because you're bad at planning. It's because your brain is wired with what neuroscientist Tali Sharot calls optimism bias. Optimism bias is the systematic tendency to overestimate the likelihood of positive events and underestimate the likelihood of negative ones. And before you think this is just about being a glass-half-full person, understand this. It's not a personality trait. It's a cognitive malfunction that affects roughly 80% of the population. Here's how it works in your everyday life. You think you'll finish that report by Friday. You won't. You think traffic will be light on your commute? It won't be. You think your startup will be profitable in 18 months? It won't. Sharot's research at University College London found that when people are given negative information that contradicts their optimistic beliefs, the frontal lobes literally fail to encode that information properly. Your brain sees evidence that you're wrong and essentially says, nah, doesn't apply to me. Now, optimism bias isn't always bad. It's why entrepreneurs start businesses despite knowing 90% fail. It's why people get married despite 50% divorce rates. A little delusion keeps civilization moving forward. But there's a threshold. A point where optimism stops being motivational fuel and becomes financial poison. Where you're not believing in yourself anymore, you're believing in magic. And nowhere is that threshold more visible than when you're losing $20 million every single month and telling investors you're about to turn a corner. That's where MoviePass lived for 2 years, in the space between confidence and delusion, where optimism bias doesn't just cost you money. It vaporizes $150 million while you smile and tell everyone the plan is working perfectly. MoviePass wasn't always insane. When Stacy Spikes and Hammett Watt founded it in 2011, it was $50 a month for unlimited movies. Expensive, but the math worked. They had about 20,000 subscribers. It was sustainable. Then, in 2017, a data analytics entrepreneur named Mitch Lowe became CEO. Lowe had previously been on the founding team of Netflix and a former president of Redbox. This is important. He wasn't some naive kid. He'd seen subscription models work, and Lowe had a belief. A powerful, intoxicating belief, backed by data analytics. He believed that if MoviePass could get the price low enough to trigger mass adoption, most subscribers wouldn't actually use it that much. They'd pay $9.95, go to 1, maybe 2 movies a month, and MoviePass would pocket the difference. The average movie ticket in 2017 cost $8.97. So if subscribers averaged less than 1.1 movies per month, MoviePass would break even before even considering additional revenue streams. Lowe genuinely believed behavioral economics would save them, that inertia, laziness, and the gym membership effect would make it profitable. He was half right. When they dropped the price to $9.95 in August 2017, subscribers exploded from 20,000 to 3 million within a year. It was the fastest growing subscription service in American history. Faster than Netflix. Faster than Spotify. The problem? Movie lovers actually loved movies. The average MoviePass subscriber went to 5.1 movies per month. Not 1.1. Not 2. 5.1. At $9 per ticket wholesale cost to theaters, MoviePass was paying out $45.90 per subscriber per month, while collecting $9.95. They were losing $36 per customer before operational costs. By early 2018, internal documents showed MoviePass was burning $21.7 million every single month. But here's where optimism bias kicks into overdrive. Instead of admitting the model was broken, Lowe and the parent company Helios and Matheson Analytics doubled down. They told investors the losses were temporary, that they'd negotiate discounts with theaters, that they'd monetize data, that subscribers would decrease usage over time, that any day now the math would flip. Month after month the data screamed failure, Month after month, they believed in the pivot just around the corner. Let's get into the actual brain science of why smart people ignore catastrophic evidence. Tali Sharot ran an experiment that perfectly captures what was happening in MoviePass's executive offices. She put people in fMRI machines and asked them to estimate their probability of experiencing negative life events like cancer, divorce, or getting robbed. Then she gave them actual statistical data. When people learned their risk was lower than they thought, their brains showed strong activity in the frontal lobes, updating their beliefs efficiently. But when people learned their risk was higher than estimated, the frontal lobes barely fired. The brain simply refused to encode the negative information properly. This isn't a conscious choice. You can't think your way out of it. It's hardwired. Sharot's follow-up studies found that optimism bias intensifies under 3 specific conditions. First, when you're emotionally invested in the outcome. Second, when the timeline is distant, abstract, or future-focused. Third, when you have illusory control. The belief that your actions can influence things outside your actual control. Now look at MoviePass through that lens. Mitch Lowe and CEO Ted Farnsworth weren't just employees. They were evangelists who'd publicly bet their reputations. Every interview, every conference, they'd promised this would revolutionize cinema. That's maximum emotional investment. The profitability was always, next quarter, or next year, never today. That's temporal distance. And they genuinely believed they could change subscriber behavior through app design, surge pricing experiments, and restrictions. That's illusory control. They'd created the perfect psychological storm for optimism bias to thrive. Researcher Dan Lavallo studied 500 business ventures and found that entrepreneurs believe they have a 70% chance of success, while the actual success rate is around 35%. But here's the kicker. Even when entrepreneurs are told the base rate statistics, they acknowledge them as true for others, but not for themselves. Sound familiar? By mid-2018, MoviePass had started manipulating its own product to reduce losses. They blocked subscribers from seeing major releases on opening weekends. They implemented surge pricing. They changed terms of service 6 times in 4 months. And internally, executives framed this not as death throes, but as optimization, as finding the right formula. The app would crash mysteriously when losses spiked. Later investigations suggested this wasn't technical failure, it was financial triage disguised as bugs. But they never called it that, because optimism bias doesn't let you see yourself as desperate. It reframes desperation as innovation. Here's where the MoviePass story gets dark, because there's a legitimate question nobody can fully answer. Were the executives delusional, or were they lying? Was this optimism bias or fraud? In September 2019, the Federal Trade Commission began investigating MoviePass for deceptive practices. In 2021, the New York Attorney General filed a lawsuit alleging the company misled consumers and engaged in fraudulent business practices. Internal documents revealed executives knew the model was unsustainable as early as October 2017, just 2 months after the price drop. But here's what's fascinating from a psychological perspective. Both things can be true simultaneously. You can know something intellectually while believing emotionally you'll beat the odds. It's called cognitive compartmentalization. There's evidence Mitch Lowe genuinely believed MoviePass would work, even as he authorized deceptive practices to buy time. In interviews after the collapse, he still defends the vision. He still says with better execution, or more capital, or different theater partnerships, it could have succeeded. That's not the language of a con artist. That's the language of someone still under optimism bias, even after losing everything. Compare that to Elizabeth Holmes at Theranos. Holmes knew the blood testing technology didn't work and deliberately faked demos. That's fraud. MoviePass executives knew they were losing money but believed they'd find a path to profitability. That's optimism bias weaponized by desperation. The parent company, Helios and Matheson, adds another layer. They were a data analytics firm that bought MoviePass believing they could monetize location data and viewing habits. CEO Ted Farnsworth told investors MoviePass was worth $3 to $5 billion. The stock price went from $9,000 per share in October 2017 to literally 1 cent by 2019, a 99.9999% collapse. Were they lying to pump the stock? Or did they genuinely believe in the data monetization strategy that every analyst said was worthless. The venture capitalist who'd invested early, Mark Lohr, pulled out in 2017 right before the price drop, later saying he saw the math didn't work. So some people could see clearly, but Lowe and Farnsworth couldn't, or wouldn't. And that distinction matters, because optimism bias isn't an excuse, but it is an explanation. It's the reason you don't need to be stupid or corrupt to destroy $150 million. You just need to be human, under pressure, and emotionally attached to being right. So how do you protect yourself from optimism bias when your brain is literally wired to ignore evidence you're failing? Because here's the thing, you need some optimism to build anything worthwhile. Kill it entirely, and you'll never start, but let it run wild, and you'll become Mitch Lowe, insisting the plan is working while the company burns. The answer isn't pessimism. It's structured realism. First, install what psychologists call a pessimi, pre-mortem. This is different from a post-mortem. Before you launch the project, gather your team and say, it's 1 year from now, and we've failed catastrophically. Why did we fail? This flips optimism bias by making failure the starting assumption. Research by Gary Klein found that pre-mortems increased the ability to identify project risks by 30%. MoviePass never did this. If they had, someone would have said, we failed because heavy users bankrupted us and we couldn't change their behavior. That was predictable on day one. Second, create tripwires. Specific metrics that, if hit, trigger mandatory reevaluation or shutdown. Not goals, but kill switches. For MoviePass, that could have been, if average usage exceeds 2.5 movies per month for 3 consecutive months, we raise prices immediately. They had the data in real time. Usage was 5.1 per month by November 2017. The tripwire should have fired, but without pre-established tripwires, optimism bias lets you rationalize anything as temporary. Third, separate decision makers from evangelists. The person running the company can't be the same person emotionally selling the vision. Optimism bias is contagious and self-reinforcing in true believers. You need a CFO or board member with explicit authority to say, the math doesn't work, and be heard. Helios and Matheson's board was stacked with people who believed in the data monetization dream. They needed a pessimist with veto power. Fourth, use base rates, not exceptional cases. Lowe's constantly referenced Netflix and Amazon as companies that lost money before dominating. That's survivor bias. For every Netflix, there are 10,000 companies that lost money and died. The question isn't, could we be Netflix? It's, what percentage of companies with our metrics succeed? For subscription models losing $36 per customer, that percentage is roughly 0. Finally, here's the most powerful question to ask yourself when you're deep in a struggling venture. If I weren't already invested, would I start this today? That's what investors call the sunk cost fallacy escape hatch. MoviePass in late 2017, losing millions weekly, would never have attracted a cold-eyed new investor. But the existing leadership couldn't see that, because they were already emotionally and financially committed. The most dangerous place in business isn't at the beginning, when you're optimistic. It's in the middle, when you're failing. An optimism bias tells you the turnaround is one pivot away. That's where MoviePass died. Not from the bad idea, but from the inability to admit the idea was bad. Remember how we started? Wall Street called it financial suicide immediately, and the CEO called them pessimists. Turns out, sometimes the pessimists are just the only ones looking at the math. If this video made you question a decision you're currently optimistic about, that's a good thing. That's your frontal lobe actually updating. Subscribe for more breakdowns of the psychology behind spectacular business failures and successes. Next, watch our video on the sunk cost fallacy and why Concorde kept flying until it bankrupted 2 countries.